Hey everyone, it's Cal Doggett here, founder of Investor Code. And today I'm going to share with you something really exciting actually. It's the first time that I've seen anyone really compare commercial property and shares and what would be the outcome of those two in a GFC or a crisis type event. So I'm going to drill into the numbers here. I'm going to show you exactly what happened last GFC and how that might give us some information to make decisions going forward if we feel that there's going to be some type of correction. You know, there's a lot of uncertainty in the market today. And so this information is just that. It's information that we can use to make an informed decision on what may come and how to prepare ourselves for that. So what we'll do here is we will go to our PowerPoint slides and we'll get into it. And then from here, I'll jump onto the Excel spreadsheet and kind of show you the numbers. So commercial property versus shares in a GFC. What I'll cover, I'll compare those two assets. I'll actually then go to the Excel spreadsheet, give you the numbers that actually drive the information. And I think it's critical there, the assumptions which actually sit behind the numbers. Any model is only as good as the assumptions which sit behind it. And in this case, we've got assumptions, but also actual results that happened last GFC, which is great. And then I'll just basically wrap it up and give you some summations. Guys, please, as I say with all my videos, please subscribe and follow if you do like my content. I'll be doing weekly videos of a similar nature that hopefully inspire and empower some independent thinking. And then sometimes people ask, well, you know, why should we listen to you? And really briefly, guys, I've been doing this for 20 years. I've got 20 years of commercial property investing experience. Well over $500 million of transactions under my belt. So I'm pretty well versed in buying, managing, leasing and selling commercial property, developing, subdividing. I've done it all. I've done well over 100, probably closer to 200 now leasing deals in my time. And that's the way I've always used to generate really significant upside with minimal risk. I cover all of that in my online course. Look, through my syndicated business, my average returns are over 21% per annum. That's the average. The worst return I've ever provided so far is about 8% per annum. The average is 21. That obviously means there's some results have been as high as 100% or more per year. And I've got countless examples of achieving 100% plus returns for me personally, my own portfolio, because I'm able to take some calculated risks that I wouldn't usually take for my investor base. And then my private clients, those who have a higher risk appetite and can really blend their debt and securitize debt slightly differently and guarantee things slightly differently and use a portfolio to generate greater returns. I've been able to do that countless times for my private clients. And I cover all of that information in my online course. But let's get into what today is about, guys. I'm going to compare two different investment avenues. So the first one is obviously the shares. And what I thought we would do is, rather than kind of a speculative share and a blue chip property or a blue chip share and a speculative property, why don't we compare as close as we can apples with apples? So we're actually comparing two blue chip assets in different asset classes, okay? So I thought, well, for the shares, why don't we go for like a Wesfarmers share? And the reason I picked Wesfarmers is because, you know, Wesfarmers Coles, I could then actually pick a commercial property that had Wesfarmers as, you know, a tenant, so Coles Wesfarmers, which is kind of as comparable as we can get, really. We've got a share blue chip and a commercial property with a blue chip tenant. Now, the assumption behind that, without actually going and picking a suburb, but the assumption behind that would be that it is in a AAA-rated suburb and it is a blue chip metro suburb where the standalone Coles is situated, all right? There's a few other critical assumptions. The first one here is that there's no debt. Okay, so there's no debt to buy the shares and no debt to buy the property. That way we're comparing apples with apples. There's no transaction costs on the way in. Now this is one that I can actually go into a bit more detail in the Excel spreadsheet, but at the moment, you know, the transaction costs for shares, very liquid market, probably not as high as your stamp duty that you might incur on the property market, which can be, you know, 4% in some cases. But like in South Australia, for example, there's no stamp duty. So I haven't included them now. I think that they can tell a slightly more, if we did include them, it could tell a slightly more accurate answer. But I think for the purposes and for the enormous difference that you're going to see now, it's actually not needed. Then we're going to assume that the tenant actually remains in the building, okay? Now that is one thing to note with commercial properties, that if a GFC event did come, or if there was some type of crisis, like a COVID or something, you could actually lose your tenant, all right? Now what we've assumed here is that if you assumed on the property side that you lost your tenant, then you would have to presume on the share side that the company folds. I mean, that's the equivalent here, because if you've got Wesfarmers as a share and you assume that that share price might fall, but there's still a company, then you have to presume that that company is still going to pay your rent in cases where they are a tenant. So again, as much as I can, I've tried to use an apples with apples. And to do that, I've gone, okay, well, on a share, you would get a dividend, which is essentially your yield. You might get a 5.5% or a 6% dividend per year. On the property side, it's really rent. And what we use to calculate that rent, or I suppose, do an apples for apples with commercial property, is we call it a capitalization rate or a yield. So the yield on the property is equivalent to the yield on shares, although they actually come from a dividend versus rent. Okay, so we're going to compare those two as a cash flow annuity from our invested money in those two asset classes. Okay, that's a critical assumption. And then I'm going to take you to the Excel spreadsheet. So what I'll do is I'll shoot across here, and then I'll try and make my window a little bit smaller. Okay, here we are, guys. What I've done at the top here is I've got essentially, this is the shares, okay? So what we do here is we go, well, there's an investment. I've taken actual dividend information from Wesfarmers shares from the internet here, and you can actually see them if I zoom to the right. You can see in 2007, let's say the GFC peaked in late 2007. Okay, so I've used the March interim dividend and the November dividend. I've used those 140 per share and 85 cents per share. So there's 225 cents per share as a dividend received in that year. And then I actually know from going back into the logbooks that the share price actually peaked here in D3 at $47 at the top of 2007, okay? That's pre-GFC. That's like immediately before the crash. Wesfarmers shares were as high as they've ever been, $47 a share. So then we've gone, okay, well, what happens if we've got an investment of $100,000? How many shares would that buy us? How many units would that buy us? Well, in this case, it'll buy us 2,127 units, and the value there is 100,000. Okay, so that's our investment quantum. Then we come across to the right, and what I've done is I've said, well, that kind of dividend in a final form and an interim form, those two different payments that were sent out that year, were 225 cents per share in total. So if we summate that, we go 225 cents times by 2,127 units that I've got, and that gives you a dividend of $4,787. What is that as a function of our investment, of which is a full 100 grand, right? So $4,787 based on a $100,000 investment is a 4.79% return. And that's where we're going to use that number to compare to our rent or our yield on commercial property. But let's stick with the shares for now, okay? So the comment here is that was the peak. It was actually mid to late 2007, and then obviously, as we know, it peaked, big bubble, shares plummeted, right? And what I've got here is actually a screenshot from my Fortify Your Wealth series, which is a series that I've actually created to arm people with some insights and some thoughts, some very thought-provoking concepts about how to ready themselves and fortify their own wealth for a GFC, okay? And you can see here, so these are some examples of actually what happened during a GFC. And we've got here, Wesfarmers shares were $47 in mid-2007, down to $13 in late 2008. That's a 73% discount in that share price in the GFC peak and bust. Rio Tinto was 125 down to 30. That's a 75% discount in Rio Tinto, which is again another blue chip share. And Macquarie shares were $97 down to 16, which is an 83% discount because of the GFC. Okay, so I just put that there because I cover all that in my online course, which is your Fortify Your Wealth series, and you can find that on investorcode.com.au. Let's come back to the numbers here, okay? So what we just showed you there was the prior. That was prior to the GFC. So really, as good as the market got, last time there was a significant correction. Then we want to look at what happens after that correction. So what happens at the bottom? Where did it bottom out, okay? And that $100,000 investment bottomed out at $13. Now, if you had the same number of units, so you've bought these units now in pre-GFC times, the GFC's happened, you still own the units. This is all part of the assumption. What's the value of those units? Well, obviously, $13 a share at 2,127 shares. You got 27,600 as your value of your shares, which is a 72.34% discount. Now, that's obviously pretty accurate. The 73% down here that I mentioned is rounded, right? But that is an enormous drop in share value. So we've got to think, okay, if another correction happens, we could be in for a really significant drop in share price. But let's look at what happened to the dividend rate. It went down from 225 cents a share down to 185 cents a share. Now that 185, if we look over to the right here, they came from these two numbers, the final dividend of October 2008 and the interim dividend of March 2009. And those two there cusped the real bottom of the share market. So I've actually said, okay, well that 50 rate per share, or that's 50 cents per share, plus the 135 cents per share, that equals 185. Why don't we put that in here as 185 cents per share, okay? Now, interestingly, there's some shares that gave you no dividend during that time. Wesfarmers is one of them that actually did, which is remarkable. The dividend there is $3,936. Now remember, although the value of our shares have come down, our initial investment capital was still 100 grand. So you've got to look at that 3,936 now as a function of the full investment quantum, which is your 100 grand, which produces a return of 3.94. Now, quite simply, that is 3936.17 divided by 100 grand, okay? Then what we do is I'm showing you here in this column, or I suppose in line 5, I'm showing you the drop, which was a 72.34% drop in value. But what was the drop in the dividend, right? It was a 17% drop in the dividend, which is interesting, okay? Because it didn't drop quite as hard as the value of the share dropped. And then what I've done is I've said, well, if you had to buy these shares pre-GFC, or let's say you owned them pre-GFC and your total investment quantum was 100 grand, and you haven't divested them, so now you still own them, but you're at the bottom of the GFC, you would have received your 4.79% dividend at the peak, and you would have also received your 3.94% dividend during, which is kind of at the bottom there. And those two together creates an 8.72% return during that, call it a 2-year period. So then what we've got to think is, right, we've actually, during that period, we've actually received cash inflows of 8.74, but we've also encountered a massive hit to our value of our investment at negative 72. Here I want to show you what actually happens now when we actually add those two numbers up. So we've got negative 72.34, then we add in our cash flow of 8.72, and it shows you a total gain, or a total loss in this case, of negative 63. So, in a nutshell, if you bought Wesfarmers shares, or you owned Wesfarmers shares, and you had $100,000 invested in Wesfarmers shares at the peak, and then the GFC happened, and you then experienced the bottom, that is the total loss that you have incurred. A 72% loss, but an 8.72% cash flow in, which is a net loss of negative 63%. Pretty damn drastic, okay? Now I want to look at what happens to a commercial property during that same time if the commercial property was leased to a Wesfarmers covenant, okay? And here you go. So now we're looking at property. We invested, let's say there's a $100,000 investment, okay? And let's say we bought a core property at a 5.5% capitalization rate. Now, where did that number come from? Well, what I've done here is gone back to the historical data, and this is data going back, as you can see, all the way up to March 80, all the way through every quarter, December 99, March 2000, June 2000, September 2000, all the way through, and I'm showing you the data here for exactly office rental yields, industrial yields, retail yields, and average property yields, and then there's a few other indicators. But the important one to note is that at the peak, so the same time period that we used for the shares, at March 07, or let's call it mid to late 07, we had a 5.5% capitalization rate for retail property. Now remember, we're talking about Coles as our tenant, which means that we are in a retail asset class. Okay, so we're buying a commercial property that has a retail tenant, which means we need to compare the retail yield. And we could buy assets at 5.5% retail yield at the peak of the GFC. Sorry, at the peak before the GFC. Okay. Now, while we're on this slide, I want you to take a look at what happens at the bottom. So this is after now the share price has absolutely tanked down to 13 cents for Wesfarmers shares. I want you to look at what's happened to a retail property yield over that time, and it's come up from 5.5% to 6 to 6.2%, and it actually then stabilizes at about 6.3, as you can see. Now, in this particular instance, the swelling of the capitalization rate creates a worsening of property value. Okay, that's the difference with commercial property versus shares. So I'll show you what that actually means here. But remember these numbers, 5.5 and let's call it 6.2, just to make the point really clear, right? Because 6.2 is worse than 6. All right, let's go back to the summary. You can see here we've got a $100,000 investment at a 5.5% capitalization rate. So that says that we've used our 100 grand to buy a property, and we've got a 5.5% cap rate, and then we can presume any rent you want here. I could put in $5,000 as rent. It doesn't matter, okay? As long as it's the same pre and post. Then what it shows is, if we've got a 5.5% capitalization rate, what does that mean for the property value? So let's say we did that, even though, let's say that, there you go. So if we were receiving $5,500 a year in rent at a 5.5% cap rate, we've got 100 grand in value. Now that is equivalent to what we had up here in the shares prior to the GFC happening. Okay, and obviously our return then, if we had no debt at all, which was one of our assumptions, no debt, we would be receiving as a commercial property owner, if we had bought that property, we would be receiving 5.5% return on our money in rent from Coles. Okay, key assumption. Then we have to look at what happened after the GFC. So the bottom of the cycle now, about 2 years later. And remember, we've got that 6.2, which came from our historical data set here. We could even use 6.3 for the purposes of this, and I don't mind doing that. I'll show you what that does in a second. But let's say we're at 6.2. It means that our property value has actually decreased, okay? Now it's decreased as a function of the capitalization rate, which means that it's come down to 88,700. That's an 11.29% decrease in property value during that time. So that compares enormously favorably to the shares, which was negative 72, okay? So we've received an 11% decrease in property prices. Now that still hurts, but what happens here for the rent? We received 5.5% in year one because that's the acquisition capitalization rate. And then in year two, if we presume that there's no escalations at all, we're still going to receive the same rent at 5.5%. So over the ownership period of 2 years, that's an 11% inflow from our money. Okay, 5.5% in year one and 5.5% in year two, assuming no rental escalations. Now, if we escalated the rent, this would obviously be a little bit higher. We could do times by 1.03. Let's presume there's a 3% escalation. As you can see, it increases slightly. What we could also do, if you want to, is put 6.3 here, and you can see that number went from 11.29 to 12.7. So the higher the cap rate, the worse the value. The values went from 88 to 87. Okay, so let's stick with our 6.2 because that was actually what it was at the same time if we're trying to compare apples with apples. And then what I want to show you is the differential. Okay, so before we go to the differential, I want to show you what that means for commercial property collectively now over that 2-year period. You got a negative 11.29% capital loss, but you got an 11% rental inflow during that time. So your total net gain or net loss is 0.29. That is such a different outcome to shares. I mean, I don't need to put it into words because it's in numbers, right? But I just think that's an incredibly compelling evidence that actually happened during the GFC. And we've got the same person paying your rent or your dividend. So you've got the same covenant underpinning your investment, which is so interesting. But because of the liquidity of the share market, it just tanked overnight. And the illiquidity or the relative illiquidity of the commercial property market meant that we've been protected somewhat because there's still land and 4 walls that mean the property value holds its value better. Okay. Now the key assumption here is that we didn't lose our tenant. And the other key assumption here is that if you're buying a AAA-rated property at a 5.5% cap rate, you have to presume that there's about a 10-year lease in place. Because if there was a 1-year lease in place, that cap rate would be 8%. So you have to presume that the actual lease that you have in place at the time doesn't expire during this GFC window, because then it would be terrible. Then you would lose obviously 0% return here, and this cap rate could blow out to 10% if you lost your tenant. So it's really critical, that assumption that we actually did keep our tenant and there's a 10 or 15-year lease to Coles, which would be equivalent to and corresponding or correlated to that cap rate at 5.5%, okay? So there you can see it, guys. You've got shares here at a total negative outcome or total loss of negative 63%. And then you've got property or commercial property here, an equivalent tenant, an equivalent yield, and you've got a loss of negative 0.29. All right, compare those. Wow, there's your difference. A 63.66% difference. Sorry, a 63.33% difference from owning commercial property than owning shares into the single biggest economic downturn that we've ever experienced in our short history. That is an incredible statistic. And I just love how the numbers tell a story here. Like I haven't gone and recreated the Odyssey or reinvented the wheel here. I just went to the internet, downloaded the dividend information from Wesfarmers. This historical data set, you can actually go find this if you want to in different places, but you know, I engaged an analyst to do this for me. He went to the Melbourne Library to get all this information. I've looked at the actual historical data for commercial property at 5.5%, which blows out to about 6.2% during that time. And that is painting an incredible story. I just think this is remarkable, guys. But there are some assumptions which underpin this. And I'll cover them again now when we go back to the PowerPoint slide, but I want to make it clear that they are, any model, any feasibility is only as good as the assumptions which underpin it. So that's why I've tried to, as much as possible, really compare apples with apples, okay? So now let's head back to our PowerPoint slide, and what I'll do is I'll go here. So, okay, this is where we were before. Now we want to go and actually have a look at what I covered, okay? And essentially what I have covered is that commercial property was superior by 63.33%. That is a remarkable difference in just owning a different asset class, okay? So same invested quantum, same tenant paying your rent or paying your dividend, one experiences a 63.33% better outcome during a GFC. That's remarkable, guys. So commercial property here wins by a landslide, all right? And we compared blue chip shares and AAA rated property, which is basically blue chip property, right? We compared those two. What I think was really interesting here is that because of the illiquidity of commercial property, there was this kind of resistance to change because there was still a tenant in place paying the rent. There was a resistance to valuation changes, okay? Obviously, it takes a lot more time to acquire and or sell a commercial property. There's got to be a due diligence in place. There's usually a finance period. There might be a settlement period. Due diligence might take 30, 60, 90 days on a good property like that. So what I'm showing you is that because there's no stop losses here, the kind of value is protected a little bit, and also behind the yield is actually four walls and a piece of land. And that land has an inherent value due to its location. And that is something you don't get with shares. You just don't. You've got a traded commodity on the most liquid market that we know, okay? And everyone who's good at shares or anyone who's sophisticated enough in shares has stop losses in place. And that means that as soon as the share drops, 10% below its purchase price, a stop loss is triggered, and all of a sudden that share price just starts falling at a rate of knots. Literally in days, you can lose 10, 20, 30, 40, 50% of your share price in a day, which is just remarkable, right? So the liquidity there is sometimes, you sometimes see investors move towards shares because of that liquidity. So if a GFC event comes, you can quickly pull your money out. But it's interesting that in this case, when you compare these two asset classes, that liquidity has caused a detriment to the way that that asset class holds itself during the GFC. So the illiquidity of the commercial property market is far superior. Now the debt here could worsen the outcome, and it could worsen the outcome for both asset classes. But again, because of the liquidity of shares, you could have a margin call, which means that there's no need for a valuation or what you might need for a commercial property. An evaluation might take 3 or 4 weeks, and there would be a whole bunch of information that forms part of that valuation. A margin call is literally an automatically generated and algorithmic, a debt calculation based on share price. So if that margin call happens, you are literally in breach the next day or that moment, as soon as share prices tick below your margin call, which is a devastating impact to you if you are leveraged into shares, right? If you're leveraged into commercial property, you might have the ability to, blend that asset out over a couple of different assets or portfolio, and you might have the ability to guarantee it, which you could also do on the share market. But you might even be able to go to the bank and ask them not to institute a valuation with your property and say, look guys, I'm in a bit of a jam right now, but I've got 2 or 3 other assets and I've got a good income and I've still got my house. Why don't we just blend this out? Let's not get a revaluation right now. So there's almost a little bit more room for nuance and negotiation in that asset class because of the way it's structured and because it's relatively illiquid. And it takes sophistication. So all these things I cover in my online course if you're wanting to know them. And the Fortify Your Wealth series is brimming with information about how to protect yourself during a GFC. But it's interesting that the commercial outcome here is a sophisticated one, but it actually ends up protecting your asset base and protecting your financial wealth. Now, the other thing which I didn't cover in the Excel spreadsheet, but it's really worthwhile covering now, is that if bad things happen, I'm one to always look for optionality that I can use to right the wrong. So the market may have worsened, but what can I do to improve the situation? That's always what I look to, right? It's always about controlling the controllables. And in shares, your options are 3. You can sell them, you can buy them, or you can hold them. Those are literally your 3 options in the share market, okay? And you can sell it, which in this case means you incur a loss. You can buy more, in which case you blend down your buy price, but you're risking more money. Or you can hold them and just say, look, I'm going to weather the storm. And that's fantastic, but those are 3 options and that's it. In commercial property, the options are literally limitless. They're only limited to your creativity. So you could develop if you wanted to. You can go to and extend a lease. You can go to the tenant and say, hey, you've got 5 years left on your lease. Maybe your rent's a bit high right now because there's been a global financial crisis. Why don't we lower your rent by 10 or 15%, but I want an extra 10 or 15 years on the lease. And your property value will stay intact doing that, and yet you've got a win for the tenant and a win for you. You can put solar on the roof. You can rentalize your hard stand. You can put signage out the front. And I mean, if you've got escalations in your lease, immediately you're better off in the share market because there's a legal obligation for the tenant to pay a higher rental next year and the year after because of escalations. You can negotiate new lease terms. You could say, look, you might have $1 million, the tenant might have $1 million tied up in a bank guarantee, and they're like, look, I really need to tap into that right now to help me get through the storm. And as a landlord, you could say, I'm not so sure about losing my security, but how about I give you half of it back, but you extend your lease term by 5 years and your rent goes up by 5%. Like all of a sudden, you've created an upside in the value of your property and you've literally lost nothing but security. So if that tenant stays, like a Coles or a Wesfarmers, you've had almost no loss but gain. And what I'm saying here, guys, is that commercial property is, yes, it's a sophisticated game, but that sophistication opens a plethora of options for the sophisticated owners and the people that are switched on to actually right the wrong that the market has done for them and actually like correct some of that property value, which has detrimented as no fault of their own. It's just the market. And I think that's why I love this property class so much, why I love commercial property. And I introduced, many clever ways to do this and to gain like an edge during a GFC event in my Fortify Your Wealth series. It's got an incredible amount of information in there, guys. And it basically walks you through what are the steps you've got to take and what are the steps that I've taken to protect myself from, an upcoming GFC. And I don't say that there is going to be one tomorrow, but there's a lot of uncertainty in the market right now. So I've taken steps to protect and fortify my wealth. So with that all being said, it's a beautiful time to summate and kind of close off by please asking you to subscribe and follow investorcode.com.au if there's anything in addition that you'd like to see. Or there's more content that you're enjoying. I'll be posting videos like this every week. And guys, in summation here, I'm very, very excited and proud to say that commercial property kicked the pants off shares during a GFC event. And we used actual data from the last GFC to show you exactly how much and exactly why. So thanks so much for following. I look forward to seeing you all when the next video is launched. Thanks again, guys.